For a holiday trading week. We got a lot to discuss today. Tesla kind of took the market down last week with this Twitter stuff, and now Musk is maybe taking the market back up by stepping down as CEO. We'll talk about that. We'll talk about the rebound in Tesla's share price. We'll talk about the quad witch, man. They pounded it. Is it the old quad witch low where we just turn around and rally for a quarter? We'll find out about that. We'll talk biotech. I have to. Some big movers there. And got a special treat for you today. Mitch is out for his birthday, but we have a special guest host coming in. And of course, we'll get our last chat of the year in with Tim Quast. So, special new guest producer, take it away.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elkanin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Let's take a look at the futures markets or the SPY. We're traded up 12 and a quarter handles. A little bit of a weak close, but we're back. Can we get back over 3,900 today? We're looking at the dollar index. That's down a dime. UUP or UUD, if you want to look at that, at 104.55. TLT, after holding up pretty well last week, that's trading down a buck. Crude just hanging out in the 75 handle, or you could look at the USO. Crude up 35 cents at 74.81. Gold climbing back above 1,800 at 1802.30. That's up $2. You can look at the GLD if you want. And silver, that's up 6 cents at 23.39. You can look at the SLV ETF. And Bitcoin, kind of a quiet weekend here. We got Bitcoin down 70 cents at 16,705. We'll bring in Triple D here from cold old Canada, and then we'll bring in Aaron Bree. Young Aaron Bree we'll bring in. Aaron, how you doing? And welcome to the show.
I'm good, Joel. Joel, thank you, and to you and Dennis for having me this morning. Shout out to everyone in the chat and the audience today. It's been it's a pleasure to be with you guys this Monday morning. Filling in for Mitch. We're going to have a good show. Like Joel said, we've got Tim Quast. We've got some good topics today. How are you guys doing this morning?
We're doing good. I'm in a snow day here, so kids don't have school today. About 8 to 10 inches of snow here falling overnight. It's pretty snowy looking out there. I was just looking out the window right now. And I'm warm in here. I'm warm in the office, so we're ready to go. Lots of good news here, at least from the markets, at least for Tesla, it appears this morning here, Aaron. So welcome to the show, and what's up?
Not a whole lot. That's exciting with the snow there. I'm sure the kids there are going to enjoy that snow day. But Dennis, you mentioned Tesla. For those who didn't see, over the weekend, Elon Musk put a poll out on Twitter basically saying, should I step down as the CEO of Twitter? He said he'll abide by the results of the poll. And yes is winning the poll right now. So people are saying, yes, Elon should step down from Twitter. And the market is saying, yeah, you should, Elon, because Tesla is up about 3% today pre-market. So Elon might see that and say, all right, yeah, maybe I really should, step down from Twitter and start refocusing on Tesla. So you can see Tesla getting that bounce. What do you see, Dennis?
Yeah, so this has broad implications here. There's been two things weighing on Tesla. One, the overall multiple contraction that we've been seeing in 2022 in high multiple names. But the second thing is no coincidence that he obviously took over Twitter about a month and a half ago or 2 months ago, and the stock's been straight down ever since. One, investors are worried about what he's saying on Twitter, so they're worried about potential brand harming of Tesla because he's tweeting too much and saying stuff that may be offending certain people. And then two, they're worried about that he's spending too much time with Twitter and not enough time with Tesla. So for both reasons, Tesla investors do not like him at Twitter. And I don't think it's a coincidence that when he first started that poll, the no's were winning, actually. I looked at it, I was like, wow, the no's were winning on the first 50, a couple 100,000 votes. And then all of a sudden, maybe it was a couple million votes, the first couple million. But then the yeses started coming in hard. And I think every Tesla investor was coming in, vote yes, we can get rid of this guy. And, and maybe that was the case or not.
I have a theory on that, Dennis, because I noticed that as well.
Okay.
So my theory on that is that when on Twitter, you can have tweet notifications on for someone. So someone gets, a blast on their phone when someone tweets. So all of Elon's biggest fans are going to have those notifications on. So in the first 3 minutes, all the people voting when he first puts out the poll are his biggest fans. And then as that poll gets more to the general audience, then it's going to get more evened out.
Wow, that's a great, perspective there, Aaron. I didn't think about that, and I think you're right. I would agree with that too. I know I have notifications on for a few people as well, major market movers. Obviously you could put Warren Buffett, but he never tweets. But I'd have to go look and I could tell you the notifications, but I had the same thing for probably about a dozen accounts that could move markets and if they tweet something. So like Jim Cramer I have because sometimes I think about stopping Jim Cramer because a lot of it's a lot of not moving stocks, but it's a certain market movers. I think it's a good idea to have on there. So that's a great perspective, and maybe that is the case. But as obviously the poll is done here now, they do want Musk to step down. He did say he would abide by this poll. They just interviewed Gene Munster on CNBC. I saw that, and he was saying that he believes that Musk will abide and step down. I mean, if we get an official announcement, like if he tweets out, yes, I'm going to step down here today, Tesla will get another pop.
Did you vote? Did either of you guys vote?
I voted yes.
What about you, young AB?
I voted yes as well. I was thinking about it because it's like I love Twitter and I think it'd be best for that. But I also, if I was holding some Tesla puts or something, maybe I would want him to hang
if you're
around.
Tesla puts your vote. If you're holding Tesla puts, you're probably voting no.
Exactly.
If you're holding Tesla calls, you're voting yes.
Exactly.
So the people who are in the position they're voting their position on that one for sure. It's so interesting, Joel, that he's so public. Yeah. I mean, the CEOs, you think about a typical CEO and they're not very public. They come on the conference call, you hear from them, periodically, maybe on an interview on CNBC or something, but not overly public. I mean, he's so public. His opinions are out there so much. Everybody knows Elon Musk and they either like him or they don't like him. So I think personally, it's a good thing for Tesla if he does step down. I will say, if he does step down, I think he gets another pop. It's very important for Tesla to hold these gains today because if he ends up stepping down and Tesla doesn't hold the gains, that is a whole nother can of worms. So because this is what Tesla investors wanted. And I'm actually disappointed, I would say, in the price action so far. I would have thought it would be up $10 at least on this. And it's only up $3.87 here. And I'm actually disappointed that it's not up more.
I'm looking at the charts here, and I'll just give you the pre-market high. You got to pop over 158. You got to 158.20. After making a multi-month low on Friday, you think this would be getting more of a pop. But for me, I'm just looking at this 161 area. If you're looking at the daily charts, you can see the last three highs, 160, 162, 160, 93, and 160, 99. All that adds up to 161 being triple star resistance. You're trading at 154.30. So I have to agree with you on that, Dennis. Boy, oh boy, it's starting to fade and fade fast. And if 161 is the number, I'll stick with that one for the week. Gets above 161, there's some room on the upside. Still, once you're hanging below 161, I think the bears are still in control, and we'll see what happens. See what happens at the closing price. That was
I'm scared for Tesla investors here. This is the news they needed. And again, we don't have confirmation. And if he comes out and says, I'm not stepping down, Tesla's really going to get hammered because now, like even Gene Munster said that it'd be a black eye for him that if he didn't follow through on what he said he was going to do. So he needs to follow through here now. I think it will get another relief pop, but I'm actually very disappointed in the Tesla pricing action here. And I have no position in it at this time. I actually had a little position. I had sold it overnight. So I have no position free to talk clearly about it here at this time. Yeah, but I'm actually disappointed. If I was a Tesla long or a Tesla bull here, I'd be disappointed that's not trading higher.
Yeah, and I was just going to say to everyone out there, our charts will look a little bit different today. We're using Benzinga Pro, but you can see we're looking at the 5-minute chart here on Tesla, and here's what Dennis is talking about. We got this pop this morning up here to about 158, already kind of selling that off here on the 5-minute chart pre-market. Not what you want to see. Just to Jay Rice's point, and Dennis, you mentioned Gene Munster talking about it on CNBC as well, of are we going to get confirmation that Elon is actually stepping down? I would think that, yes, we will get that confirmation either sometime today or tomorrow. And
I would think so too.
Partly because in the poll, he specified when he put out the poll, I will abide by the results of this poll. So if he specifically put that clause in there and then didn't, like, it's not a legal contract, it's just a tweet, whatever. But if you say specifically, I'm going to follow the results of this poll and then don't, that loses some people. Some people are going to be like, all right, what's the deal with that? So I think he will end up abiding by.
I don't think he has a choice, Aaron. I think you're right. I don't think he has a choice. I think he absolutely has to step down here now. And
who's going to take over? Who's going to take over?
Well, he'll find somebody.
Yeah, I mean,
maybe he already has somebody. He kind of probably knew. To Gene Munster's point is that Gene says he didn't want the job. He didn't want to take Twitter over. We knew he had to, and he didn't want the job. And this is his out. This is his way of, well, we'll let the people decide. So maybe he already has a master plan here. He's smart. Maybe he already has somebody ready to go on that. But I don't think Tesla investors even care. I think Tesla investors just want him back running Tesla. Stop tweeting so much. Like, maybe you're not going to slow down the tweeting, but maybe you will if he's not just so involved with that. So it's a win for Tesla no matter what, I believe, if he actually does step down as Twitter's CEO. With that being said, the Tesla valuation is still a problem. The recession potentially coming, which I've been calling for, is still a problem for Tesla. And market investors are saying, hey, only $3.50 on this news is like, okay, now we're starting to see that maybe it wasn't all just a Twitter situation, but it was multiple contraction here and people worrying about a recession. That is the bigger problem for Tesla.
Got it. Well, let's go ahead and leave the Tesla discussion for now. We can get back to it if we get any more news or if anyone has any final thoughts or questions in the chat. But Dennis, I'm curious just about last week, kind of the opening, closing, and balances as we head into the holiday week. What are you seeing just in terms of the overall market and trading right now?
So you had some significant imbalances on Friday. It's always hard to remember back after the weekend there, but we've been straight down for 4 days. I mean, we're now oversold here on some stocks. We're oversold probably on the overall market in the short term. But I do think there's so many people underwater. I think rallies are going to be sold as well. So I'd use any strength. If we get some strength, maybe we could bounce 100 handles, at some point in time here on some type of news. I would use that strength to sell, even 50 handles. I mean, I'd be using strength to raise cash. I do think 2023 is going to be a very rough year for stocks. I would absolutely be selling all those value names at this point in time. They've rallied too much. I mean, Caterpillar, again, still sitting up near the highs. Doesn't want to sell off. Deere sold off, bouncing back, giving you lots of opportunities here. But if we go into recession, they'll come for these names too. So, I mean, these names have held up well. Maybe they hold up well into the end of the year, and this could bring us into a conversation, Aaron, about tax loss selling. I mean, everybody's expecting the big Santa Claus rally. Everybody's expecting that, hey, this is going to turn around. We're going to get in here, and that's going to be a really good rally here towards the end of the year. One thing to consider is that, we're kind of been spoiled in the last 10 or 12 years because we've been in this relentless bull market. Most of the years have been up years. What you actually see sometimes occur at the end of the year is a continuation of the whole year. So we're, maybe your perspectives are skewed a little bit because, 8 or 9 or 10 of these years of the last 12 have been up. So then you just see that continuation of, the move. But 2022 has been a very bad year for stocks. So I would think tax loss selling is going to come into play in a lot of those beaten down names. So I don't think I would be coming in here and buying the squares and buying all those other ones saying, yeah, they're going to bounce towards the end of the year. The opposite can actually occur here, that there's so many bag holders sitting on these stocks, you could see continued pressure. I would actually be thinking about January 1st as more of the time that I would maybe start to buy some of these beaten up growth names, as opposed to trying to come in them with 2 weeks left thinking you're going to get this end of the year rally.
Couple things here on those comments. Just going back, the balances, they were really flipping in the morning, right? because I saw
They're
a lot of
flipping on night
yeah,
too. They were really
yeah,
flipping,
yeah. There were no
flipping
discrepancies,
imbalances.
and then the little rally at the end of the day. Maybe they came in a little bit to the sell side because I even saw some after hours trading. But we just technically here, just going about the market and Dennis, what you had talked about the continuation of the
Yeah,
trend. Um, you know, we lost the number, my bullish levels last week when we took out the prior week's low at 45.75. So we have a new bogey on the downside, obviously, and that's Friday's low at 55 and a quarter. That's 90 handles lower. The only thing that like the bulls, and it's not a very big hat rack, that you can hang this hat on, is that you do get turns in the market off quad witch expirations. Major turning points in the market, either major highs or major lows. So the Bulls got a lot of work to do this week, and they
they
got to
do.
defend that low from Friday. Because when I look at the daily, and you can bring up the daily and the SPY, when I bring up my daily in the S&P, and markets don't go all right to where you think, but there's just no daily lows in here to support that area. The two major lows that you have are under 3,800 at 3780. So are we going to build a base above that? So I reiterate, maybe the quad would turn, but and we talked about this too last week, Dennis. It just seems like on rallies, people know where they want to sell. The
Yeah,
orders are there. I wasn't here last Tuesday when you had that ridiculous pop off the PPI number, or the CPI number, but people aren't they're not in the buying mode. Like they're buying these dips, they're renting stocks, but you just don't see feel like these institutional bids are just like, I'm here at 110 and you're not going to move me. So
no.
that just echoes your sentiment moving into the end of the
It's still
year.
that sentiment. It's turned, and I mean, maybe it's a crowded trade to the cash side now. Maybe it's a crowded trade to the what's going into recession. And that is a concern for the bears. But again, I don't know. Like, I think there's a lot of people who still think this market's going to bounce back next year, and I'm not sure that happens either. So I'm not even sure what the consensus. Like, it feels like it's bearish out there, but there's still people doing stuff. I mean, I don't even think the recession has hit yet. So
Right.
I'm still of the opinion that I want to have cash here because I think there still could be some ugly times in 2023.
Yeah, and so Dennis, I want to get back to something you mentioned real quick, and I see some people in the chat mentioning
Yep.
MDGL and some other biotech stocks. We will get to biotech in a few minutes, but real quick. So Dennis, you mentioned value stocks kind of showing some weakness, and that was something I noticed the past couple of weeks. Was if you look at the XLF financials or XLE, both had been kind of selling off, and you typically only see energy and financials selling off together in times when people are starting to get more worried about a recession. And to your point, when you start seeing those value names go off, doesn't necessarily mean, okay, it's time to start buying the squares and the growth stocks, at least not yet. Is that what you're saying?
Yeah, I do think I think I'm just trying to look at the overall economy here and saying, hey, it's been holding up really well, but I just don't think it's going to continue to be the case. I think it is going to slow down. I think interest rates will have their toll. But this is a great observation by you, Aaron. I mean, the banks are telling you something's wrong here. Bank
Right.
America is down 20% here, Joel, in a matter of about 2 weeks. I
And that
mean,
doesn't
this has just
happen
been
if the
quiet, and I'm ballparking at $6, 38. So let's say 15%. We can safely say down 15% in the last 2 weeks. I mean, this is a serious sell-off here.
it's one of the
Wells
biggest banks
Fargo,
in the country. It doesn't happen unless
something's up.
some people are worried about the outlook of the economy. It doesn't happen
Yeah.
unless if everything's humming on all cylinders.
Something appears to be up with the banks. And Wells Fargo, same story, $48 back to the lows at 41. JP Morgan holding up better again. Jamie Dimon, people trust Jamie Dimon a little bit more. JP Morgan still one of best of breed, but I'd be concerned there may be some fall through here too. But you are seeing it on a lot of the banks. You're starting to see some serious weakness here. I mean, look at the regional banks, KRE. So if you just want to take the overall index here, full of regional banks, 64 to 56. I mean, we're down 15%, Joel, 2 weeks. What's up?
Maybe
I
we'll have to
mean,
get
this
Melvin on
is
the.
supposed to be the value trade, supposed to be like, yeah, we're moving from high PE to low PE. Banks have low PEs. This is telling you something else is going on here. I do believe that investors are preparing for a recession 2023 here, and they're voicing their opinions by selling some of these banks.
So, Dennis, couldn't the flip side to that though be, and just I'm playing devil's advocate, and
No,
I
I
don't
like that.
don't necessarily think it's a time for growth stocks either. But if we are heading toward a more recession and you have these value names, whether it's energy names, bank names that aren't killing it, that aren't making a lot of money, those stocks are going down too. Aren't you then at that point more incentivized to start taking a stab at some growth stocks? If you're like, all right, if no one's making money, I might as well buy the ones that are going to grow more.
Yeah, but again, growth stocks get hit even harder during a recession. It's again, we go back to the lack of the TINA trade here. We talk about the TINA trade for 10 years. There
What's
is
that?
no alternative. All of a sudden, the alternative is there, and the alternative is very attractive here. Like I said, in Ontario, and you're coming into the 5% range in the US too. But government-free, risk-free bonds, and they'll say, the Bitcoiners will say nothing's risk-free, the government's going to collapse, and we're all going to die. But I mean, we got to be on Bitcoin. But let's be honest here. If the government, if we're not going to honor, government securities here, then we're going to have bigger problems in the stock market. So if you're comparing stocks to cash right now, 5.1% is what you can tie. 5.2. I was seeing 5.2, and those are posted rates here now, Joel. You can negotiate those.
We should go in. I want to go in that. I want to go into that for a second.
On 1 year, year money. Even 2 year money, 5.1, 5.3, 5.5. I mean, this is Ontario GICs, government insured. So I mean, you're not risking anything here. So
for the younger investors out there, Dennis, this is like a new word. Like Aaron just said, and Tina. There is no alternative. For so many years with interest rates so low, right? You couldn't make any coin in the bank.
Nothing.
You couldn't make anything on CDs. So there was no alternative into being in equities. And I know you're fairly young, around my daughter's age. 5%. That was unheard of, and there was no alternative to the market. But now in a rising interest rate environment, there is alternatives. Yeah, if inflation's 8% and you got 5%, well, yeah, maybe you're losing 3%. But would you rather lose, theoretically lose the 3%, or be in stocks that were down 20% for the year? So it's a whole new dynamic. And also it helps out other people. It helps out people that have been on fixed income. It helps people out that have been weary of this market and have been holding on to cash. So there's a different alternative. I just don't see rates going back down. I mean, this is like going to be a half-hour discussion. I don't see a pivot turn. I don't see rates stop going up. I don't see them starting going down. And if and when they go down, I don't think they're ever going to get back down to those ridiculous levels.
He said
that
it,
they were at.
He said it last week. There's a reason this market is relentlessly selling since the Powell. They wanted him to start talking, dovish here, and he went more hawkish and said, we can't even start thinking about pivoting here. We're still trying to beat the inflation. So the rates could be up here for the foreseeable future. And if those rates stay up here, for the foreseeable future, we will go into recession. So I do believe they're going to start cutting rates probably in the back half of 2023. And I believe the reason they're going to do that is because the economy is going to fall off a cliff. I think it's going to be ugly. I don't think we're going to hit a soft landing. I think we're going to see in the first quarter of 2023 spending start to drop significantly. For earnings, maybe coming out, January, February might be okay because we're in the fourth quarter. But I'm more worried about let's get to April, when we start seeing the first quarter earnings. You might start to see some earnings warnings. FedEx is warned here. I think it's going to be ugly. I think it's just getting started, the recession here. And I think that's going to show up in stocks. Now, I do think there's going to be an opportunity in the mid part of 2023 to buy stocks because I think the Fed's going to have to take action because I think they've overshot.
Right. So I was just going to ask Joel and Dennis, you guys have been through, this with the Fed a couple, probably more times than I have. So how much of when Powell's talking right now, do you guys really trust essentially everything he's saying versus you think he's just trying to kind of jawbone, scare the markets, not make sure there's any sustained bullish activity before inflation is really, smashed?
What a great point again, too. I mean, there could be some of that, and that's definitely a possibility. Don't kid yourself. Powell looks at the market and says, we see that CPI data, and we see the S&P blast off on that print. We see it holding up at 405 here, and we're like, well, I don't want the wealth effect starting to go counter to what I'm doing, so I'll talk the markets down here a little bit. Yeah. I think that's the case. I think the markets would have got hit ahead of it further. He might have not been as hawkish, but the markets were trading 405 on SPY when he started his press conference there, and he wanted to make sure that, hey, I don't want these stocks just blasting off into the end of the year here because that's counter to what I'm trying to accomplish. So I think it's a great point too. I think he was a little bit more hawkish because the market was, looking for an excuse to blast off to 420, and he did not give it that excuse.
Yeah,
No,
you
he
can
did it. He did it in Aaron, and that's a great question because a lot of trading and investing is relying on past circumstances, right? What was the situation, and whatever you think, if he's doing a good job, a great job, a horrible job, he is confronted. There's no textbook for like a pandemic, where you have supply side shortages to an overinflationary period. We're still coming out of the pandemic. I mean, there's no script for this. There's no, like, oh, this happened, like this isn't '08 and this isn't '89, and it's not the Great Depression. This is a real and let's just throw in a war, in the Ukraine with Russia. And let's just, throw in China and they're vacillating on their COVID restrictions. There's just like he is dealing with so much, and I know that he was transitory for too long, and
Yeah.
now people think he's absolutely killing the economy with the rising rates. But there is no playbook. And then when I look at my long term investing, when I'm like unsure of the macro, when I'm unsure of the global market environment, then and you could still go to the bank and get 4.5, 5%. I mean, what do? You just got to let things feather out. So it's really really
We're
a new situation, a new world we're living in.
we are. We've had easy money here for 20 years. 20 years
Mhm.
have driven this bull market into valuations that it had no business being at. We had no business trading 27 times earnings on the S&P at the end of 2021. No business up there. We had no business trading 100 times earnings on all these stocks, or 20 or 10 times sales, or 15 times sales, or 20 times sales. It's all come to roost. Now, again, the value trade has, outperformed, and the value trade's been very good. But my concern is that the value stocks, they've crowded, they've kind of flocked investors from growth to value, and we've seen that trade happen. But now I almost wonder if you shouldn't be going from value to cash, because the value stocks like the utilities held up so well. And I've been calling for a utility sell-off for a while. It really hasn't occurred. I do think it's going to eventually be coming, though, because why in the hell do I want to go take stock market risk, even though utility stocks, people still pay their utility bills. They're very, recession resistant. But with the TINA trade being dead, I'm like, I'd rather just be in cash than utilities. So I'm shocked, that somebody's going to go in and jump into an XLU for a 2.9% dividend, or into a Southern for a 3.92% dividend that isn't growing much, when they can go get 4 or 5% in cash. It's actually surprising me that those stocks haven't sold off more.
Boy, that
Yeah.
Southern had a nice rally. We were looking at that thing a
Nice
while
rally to
ago.
sell.
Yeah, it had a rally, but looks like it turned hard at 72 there. Looks like it's going to get back maybe half of that move to 66 or 67. But yeah, the XLU, I mean, everyone was hiding out from that when people came out of that trade. That's when we got the relief rally in the market. But boy, it looks like I'm just looking at that XLU, 4 red days in a row, breaking down through a consolidation area. That chart's not looking too good.
I mean, Aaron, bring us to the bullish scenario, because the chat's hating what I'm saying right now. They want to hear that they're going to get all their losses back in 2023. They don't want to hear that it's going to be a worse year for stocks. And there's a case to be made that, hey, I could be wrong. Maybe we don't go into recession. Maybe we do go into the soft landing. Can you tell, do you have a bullish scenario here, Aaron? Do you think? I'm throwing you right under the bus here, but you said you like to play devil's advocate. I'm asking you to play devil's advocate with my bearish recession scenario.
There we go.
I do think there. I mean, and I think it goes back to what we were saying, is that if there is a lot of what Powell is saying right now, he's doing so, in the sense of to try to just suppress the markets a little bit, but knowing, because if he comes out and says, hey, we have made a lot of progress on inflation, we're going to, do a smaller rate, 50 basis points this time, maybe do 25 next time. And we're looking a lot better than we were 3 months ago, which may be the truth. Like you said, market goes up to, all right, look where we are on the chart. So this is a SPY daily. Right where you were talking about, we hit our highest point since like September or you had to go back here to September, the last time we were there. So you have Powell saying, okay, we've finally made some progress on inflation. Now we want to give it all up and see the market rip back up to 430. No, he wants to scare it a little bit. But the Fed's whole, post-great financial crisis framework is built on avoiding another situation like that, avoiding, banks failing, having to bail out the auto industry, all these things. So that being said, as soon as some cracks really do start forming, I do think he'll go back on that. We're not going to cut rates until the end. He'll cut rates in February if he needs to. So he's not going to say that right now, but that is my bullish case, is that a lot of what he's saying right now, he's not, is more so just to kind of dampen the markets and not really about the whole outlook of the economy in 2023.
I'll come in the middle here because Dennis, you're giving a bearish perspective, and Aaron, I don't think we're going to see a rate cut in February, no matter what the circumstances are. But I don't know. I don't know if I need to come up with a term of like a rolling recession, because there are pockets of the economy. I know there's a lot of layoffs going on in the tech industry, and there's going to get a lot of people that were making 150, 200 grand a year. They're going to be out on the street, and they're not going to be able to replace those jobs. But then again, I look in the service sector, and I look in the airline sector, and the last few times I fly, they're taught to the stewardesses and boots on the ground, and they're like, the stewardess from Delta told me they were hiring 6,000 pilots and stewardesses and mechanical people because they just can't meet the insatiable demand. Now, is a recession going to suck that out of it? Are people just spending like free willy because they were, locked up for 2 years? We talked to Michelle Krebs a couple of weeks ago. Is there, is there labor, do you see unemployment coming, higher from the car industry? She said no. Going to a more personal standpoint, my wife looking for medical assistants, can't find people to work in their office. So maybe it's not going to be those really, those high paying tech jobs are out there. Those are going away, but it's going to take a long time for the economy to transition to, to more of a service industry. And that's what we're seeing happening. So I definitely don't see a booming economy in 2023. I'm hoping that it's not a deep recession, but for me, what I'm keeping an eye on is, is that unemployment rate. If it starts going, 3.5, 4, 4.5, 5, 5.5, 6, then boom, we're toast. And right now, we don't see that.
And I'll just say, wrapping up my point, I don't think the Fed's going to start cutting rates in February. My point was that if, Bank of America is talking about having to lay off half their staff or their business going, whatever, some big cracks like that are forming, then the Fed may have to reconsider earlier than initially thought. And the other, part that I'll give just on being somewhat bullish here is we have seen now inflation come down a decent amount without a big increase in employment, so I'm not saying that a soft landing is possible, really, because it doesn't seem like Powell thinks it's possible. Powell's basically saying we need to see unemployment go up. But if you would have told people 3 months ago that you would see inflation come down a little bit without unemployment skyrocket, people would take that as a good sign. And I think that helps us understand why we were trading above 400 on the SPY compared to where we were 2 months ago. Is because a lot of people didn't think that'd be possible. We've made some progress there, but still got a ways to go, and the Fed's continuing course.
Should we bring Tim into this conversation?
Yeah. Do we got Mr. Quast in the background?
I do not see Mr. Quast in the background. Let me give him a ping real quick.
He's timely, though. 30 seconds still to his spot. So
he's 30 seconds to his spot.
He's a busy boy, so he probably didn't come on until the last second.
Okay, just real quick on the update. Since we came on the show, we have a little bit of a fade going on here. We were trading comfortably up, in the 30, 39, 90 area. That late day rally that got us halfway back, just from the daily range, and I take the daily range from the Globex high. That was at 38.95. We faded just above that. We're fading again. I think your setups are for early this week. I think what the bulls need to prove, and they're not doing a very good job of it right now, is that we're going to get over 3,900. We're going to do some work in the 3,900, maybe get up to Friday's high. That's what the bulls need to do. And all the bears are thinking about was, man, there's nothing under that low, from Friday. If we can get into that area. The other thing that's concerning to me, bring up the Apple chart here, is that we've come down to this 135 area. We've come down once. We've come down twice. We've come down 3 times. This is the 4th time down. and we are not bouncing out of here. I mean, yep, we're up 40 cents. But if Apple, even if it struggles to get over yesterday's high, you're talking about a major area of support that's being breached. You're talking about the top component in the S&P 500 index. You're talking about an area of 3 monthly lows of support. There's a lot of things that are not adding up to a good week for the market.
That chart looks horrible.
It
I
You're
was
does.
just gonna
talking
say.
about 24 times earnings on a stock
It
that,
does.
7-8 years ago traded at 10 times earnings. You're talking about a company that is a cash cow. But again, if we're going to recession, maybe I'll just hold off upgrading my iPhone for the next year. Don't think Apple is recession proof. People call it a consumer staple. It is until it isn't. So people like the new iPhones, but they have to eat. They don't have to upgrade. So I think there's a concern. I've had my Apple in my long-term portfolio for the better part of a decade, and we know I hedged it all at 155. I was hedged early because it went to 170 afterwards, but I've said on this show I could see a scenario that Apple could get under $100.
Yeah, I mean, Joel, I mean, I didn't notice how bad this Apple chart looked either, but Dennis, like you called, Tim Quast came in right at his at his allotted time. I see Mr. Quast hanging out backstage. I bet Tim didn't know that he'd have me, producer AB, on pre-market prep this morning, but I see Tim still dark where he's at because he's out west. But let's go ahead and give Tim his intro and bring him on the show. See what Tim's been watching. Mr. Tim Quast, Market Structure Edge.
That was good.
Who's that old guy?
I love
Hey,
that.
Good to see AB. Nice to see you for a change. It's been a while. Yeah,
It
you
has
look
been.
you look good. You look
Thank
good.
you.
Looks like
Thank you.
2022
the reason
treated you all
Tim
right.
was late is I got to tell everybody is that he refuses to hire someone to plow his driveway, and he has 150 inches of snow, Dennis. You can't complain
I
anymore.
can't compete with Tim.
So he was up, or either that, or he had his wife out there shoveling away, and then he's like, "Oh my gosh, it's time for pre-market prep." So we're glad you're here. To walk us off a cliff here. The SPY's down 5% in the last 2 weeks, 2 losing weeks in a row. Teach us a lesson, Tim. What can we learn from that?
Well, and you know, I talk only about market structure, Joel, and thank you. Good to see you. So to me, there are core market structure points. And by the way, all this stuff coming from the SEC that dominated the news string last week, 1,600 pages of proposed rules, that, folks, is market structure. It is the mechanics of the stock market. And you have Apple up there, and you can talk about the fundamentals of Apple, which look, it's a great business and probably will continue to be. But the fact is virtually all prices are set by computers, machines that are programmed to do things that have nothing to do with a multiple of earnings. They have to do with supply and demand. So, Joel, my answer is there were 2 things to know heading into the past 2 weeks. Number one would be the last options expirations period of 2022. And number 2, broad sentiment was above 6.0. And there is again, it's just statistics. All that broad sentiment, the way we measure it, tells us is when large institutions are likely to reweight or commit more funds. And it is an absolute statistical fact, the way we measure data, that the probability that the market rises when it's above 6.0 is 0. And I said to edge users, I write a daily market desk note to edge users, that the probability is that SPY would return to about 382 because that's where it was when it went over 6.0. Well, where are we? It's 383, right? Very close to where you would expect it to be. So what do you do during those times? Well, there are always things to trade. But that is the explanation. Why is the market down 5%? Because the demand in the market told us that large institutions would reweight and it would have a negative effect on the market. And number 2, when options expire, trillions of dollars of, you could think of it as insurance policies, reset, and everybody gets a bill. You get a bill and you look at it and you say, well, am I going to renew this insurance, or am I going to drop the comprehensive coverage and go to just liabilities? It's just a way to think about it. But both of those things were happening. And it's nice to know that ahead of time. So, I sold Evergy, which we talked about last time. And I just sat there and waited and it's nice not to be down 5%. And that's how you do it. Traders, the key to success in short-term markets where all the rules are biased toward helping people with an investment horizon of about 300 milliseconds is to be very aware of supply and demand in the market, and it will help you. But that's why, Joel.
Tim, I want to take this into a conversation about market structure here, because we did get some changes, some proposed changes coming from the SEC. I don't know if you had a chance to leaf through any of the proposed changes, but they're going to adjust tick sizes, which I found very interesting. Obviously, looking at some more disclosures and stuff too, but maybe start with the tick size discussion here, because this obviously is going to change market structure substantially. It's the first major changes proposed really since Reg NMS here. What are your thoughts overall, and then what do you think of the new tick sizes potentially?
Right. So, and traders, the reason that you have to look, it's mind numbing. I realize that. And you think, why would I care about this stuff? I just want to trade good stocks that are likely to rise if I'm long or fall if I'm short. And would that it were that you could just, count on those two things, but you can in a sense. So my impressions, Dennis, I read the summaries. I read everything that the Wall Street Journal, either editorially or journalistically, has written about it. The big folks who write for the Wall Street Journal about those things tend to be Alex Osipovich, Paul Kiernan, Telestimos, who used to be at the New York Times. So, and I know them all. The one word that you will not find in anything, any of the documents, any of what's written about it, is the word issuer, which, by the way, is a public company. And the stock market does not exist without public companies. So very, very quickly, if you go back in history is a great teacher. What created the great capital markets of the United States? Well, it was a group of brokers who said, we will charge a minimum commission and give each other preference so that we can provide a supportive ecosystem for public companies and investors who want to invest in them. And that worked for 200 years. That was the Buttonwood Agreement in 1792 that created the NYSE. The Reg NMS, which you mentioned, Regulation National Market System, upended the two core principles of that agreement, which were a minimum commission. That's how you get a $2 broker, $2 minimum commission. And we will give each other preference. So the first place you go is this group. Can we buy and sell amidst each other? And if not, then we go somewhere else. Well, that's gone away. Reg NMS prohibited giving preference to anyone, and it capped fees at 30 cents or 3 mils in the market. And so what did that do for traders? Well, it destroyed the ecosystem that supported the formation of public companies and the support of them in the secondary market by banks that would hold the stock and write research. That stuff has been demolished, and the market has been turned over to machines. No offense to the Citadels of the world, but they don't have any customers in that market making operation. They don't write research. They don't carry shares. They don't want to own anything at the end of the day. So what you end up with is a market with tenths of pennies mattering to the folks who are setting all the prices. Well, it's antithetical to the interest of public companies that have long-term horizons to create wealth and growth for long-term committed investors. Okay, so that's what we have. And my impression here is that the SEC has thrown the exchanges a very meaty bone. Realize that the exchanges have sued every time that the SEC has attempted to address this market that favors very, very fast machines over everybody else. So this time they said, screw it. We want to get something done. We're going to make sure that the exchanges get something out of this. And this is intended to move a lot of that volume that has gone off of the exchanges, over 40%. I talked about it in the live demo for the edge users this last week. On Thursday, 48% of all trading occurred in dark pools. Well, they're trying to push that back to the exchanges. The exchanges love it because they sell data and they want more prices. And so it works to their advantage. Does it help you as a trader? No, but because the core rules won't change. Market makers will still be exempt from having to locate shares to short. That is the meme stock issue. It's nothing else. And they did not address that. It's not payment for order flow. It's not Citadel is rotten. Citadel didn't do it. Okay? That's not the issue. The issue is market makers can just manufacture stock to fill trades and then go away, and the stock prices crash. So that is the problem. That didn't go away. And the ability to cross a bid-ask spread did not go away. It's just going to be forced onto the exchanges. I much prefer to execute my own trades in a dark pool because I get a bigger order. So I
Are
don't
you
want them on the
concerned? And
exchange.
here's another concern: is now we're fragmenting price farther.
Yeah.
And I mean, I like the idea of going like a half tick for maybe a Bank America, but I think they might have taken it too far with this 0.2 bucket. And it's going to capture a lot more stocks than I think they maybe even intend to. Like I could see how Amazon could now go down to a 0.2 and trade in 20th of a cent. I mean, is there really any benefit here to having Amazon, which at one time, we just go a year ago, was trading with a 10-cent spread because it was a $2,000 stock. And now we're going to take it down to a 20th of a cent. I think they're overshooting here, are they not?
Well, it leaves out, there's a gaping maw in the data that nobody talks about. And, you know, traders, you should bring this up. Look, when you comment, and you can comment to the SEC about these things, you cannot talk about narrow spreads while omitting volatility, but they do. Nobody talks about the fact that the average stock in the S&P 500 moves 2.5% per day between the high and low price. So what difference does it make if there's a tenth of a penny spread? That is confusing busy with productive. The problem is when prices fragment, it increases a greater likelihood that prices will have wide ranges. Look, we use it. We teach you, edge users, how to use that, right? This is what we say. If a stock has rising demand and falling supply and it's got 4% volatility and it's down 2% today, what is the probability that in the next 2 days you make money? Nearly 100% because of the rules. So you can, I had an edge user send me an email over the weekend. He said, I have made 100% returns. I have never lost money using that. So and that's from, we call it the Hicks rule. Anyway, it's an inside joke, but there's your point. Yes, it doesn't matter what the spread is if there's tremendous volatility, but traders, the good news for you is we can navigate this. I understand it. You know, the crew here, Dennis is one of the great experts on how the market works. We understand what effect these will have and what's good and what's not. And the core thing is that if you understand that these rules benefit not you, they don't benefit you, even though that's the story that we're told, they benefit people who want to make a tenth of a penny. If you cut the spread to a tenth of a penny, who are you benefiting? People who want a tenth of a penny. It's not benefiting you, okay?
Joel.
Other than that, I don't have an opinion.
All right, so
gonna
what
be
should
interesting
investors do
So
this
these
week?
changes, just to sum up, these changes are being, you know, they're going to be a comment period here.
Yes.
And they'll probably be implemented in the second quarter of 2023. So we're a little ways away from implementation here yet, but these are proposed and there'll be a comment period and they may not go through, but in all likelihood, a lot of these changes are going to go through.
And it will take some time. And remind me, AB, when we get into the new year, I'll make sure to give you the links so you can put that in the chat for how to make comments on this. And we can certainly talk about the core things. What should matter to you, retail investors, is do I have the capacity to execute a trade favorably? And I'm telling you, you do. You do. You know, it's never been a better time for retail traders. There are things I don't like about the market, but these are true things. If there's a spread, I use it if there's a spread of less than 20 cents. Okay, you with me? To stocks $20 to offer and $20 2020 bid. Sure. That's a spread of 20 cents. And so if you execute a trade at the market, meaning I'm going to take the best, I'm going to just hit what they're offering to sell it at. And I put in a trade of 100 shares. I trade in 99 shares all the time.
Right, you talked about that. Yep.
Right. That trade is going to get filled between them. you're going to get a great price. Okay. You already can do that. You can already use it to your advantage. What this is going to do is add a lot more complexity and fragmentation. It's not in our interest, but this process will drag on. The truth is, retail traders have a good deal. The people who do not have a good deal are public companies.
All right, Tim, before we let you go, we're getting
Yep.
up against the clock here.
Yep.
I'm going to put two things together here.
All right.
What should investors do this week? And unfortunately, with the way the holidays are falling, this is the last market structure Monday of the year.
Hard to
So
believe.
along with the heads up for this week, give us one big thing for 2023.
Okay, I can do both. So if I were going to trade anything this week, which I might, I tell whatever I tell edge users is what I do, and the math is there. I use the same math that will show up on your desktop, the dashboard here. I've got this over here, Benzinga, December 19. Notice this, the supply demand. There's supply demand separation, exact opposite of airlines and cruise ships. See how very, very weak demand, rising supply. That's not what causes stocks to go up. That causes them to go down. So if you want to short stocks, you short a stock about right at 5 that has rising demand supply that's over 50%, close to 60%. You probably make money on the short side all day long doing that. So this is the opposite. If I picked one thing out of here, Joel, that I think is good, the irony is it's probably Evergy. I mean, Evergy has gone from a big and stable to a stock that just hit 10 with falling supply. Well, generally speaking, that will produce a return. It's not going to produce a lot, but if this stock is down today, 1.5%, I'm buying that because it's probably going to give me that much tomorrow or the next day. That's not a lot, but it beats declines, and you can wash, rinse, repeat that over and over. So then the big thing, I have a real making predictions always renders fools of everyone. So with that qualifier, right? If you want to appear a fool and then confirm it, open your mouth, right? So but here's what I will say: I am predicting that we will have a flash crash this year. That is, so if you go back to May 6, 2010, the market fell apart. I don't know when or where, but the reason I'm saying this will occur is because the market has become so driven with purposes that are other than the economic factors that we can observe with our eyes, that a wide gap forms between them, and at some point that's going to reset. So I will say it will come with maybe a bad jobs number. All of a sudden, whoa, 500,000 jobs lost in a month. That could happen. A currency crisis. Does the Japanese central bank have to intervene because the yen is weakening so dramatically? That could happen. Or a large bank fails, like Credit Suisse. I'm worried about Credit Suisse.
Yeah, I am too.
One of these kinds of things will precipitate it, and we'll look back afterward and go, holy crap, what happened there?
Yeah.
I think that is going to happen in 2023. It's not the end of the world. I'm not a bull or a bear. I'll just use data to make money consistently. And you will be able to do that, traders. So don't be frightened. But I think that the probability is very high that happens in 2023.
So we bring on Tim Quast to raise our spirits.
But he tells us the market's going to have a flash crash.
And for you guys that don't know this, Dennis wrote about a potential flash crash in January of 2000 in the CFA magazine because of the stock Rambus. Is that still around anymore?
Yeah.
Rambus.
What I did is I extrapolated the price action from Rambus, and I extrapolated it to the whole market because I'm like, this market is so fragmented, and obviously we have no affirmative obligations. I talked about all that, and I said the market makers can just go off. So I'm like, we're gonna have a scenario one day where we're going to get very heavy on the market making side, where we're drifting down. The market maker's like, we're too full, and we're just going to hit the shutoff button, and we're going to have no liquidity at all. And I said that, and I posted that. It was on Zero Hedge as well. In January of 2010, I said, was the Rambus flash crash a sign of things to come in the overall market? And then obviously we had the flash crash on May 6, 2010, 4 months later. So I mean, it was a predictable event if you understand market structure. So we have a
There
few
you
things
go.
to help us. We do have
Yeah.
circuit breakers now
We
here,
do.
Tim. We do
Yep.
have some band-aids that it probably isn't going to get to a situation where we're going to have
Right.
stocks trading at 1 cent here again.
Right.
But, there
Won't have
is
that.
liquidity concerns here still, and there is concerns that the majority of our market's liquidity come from a very few number of participants.
Yes. Yeah.
All right, let's wrap it up,
That's
Tim.
it.
Thank
Tim wanted to
you.
comment about. Well, we only got 4 minutes left. So.
Yeah. One final comment, Tim, since we're not going to see you till next year.
All I would add is that while there are four, and I've mentioned these things before, there are 4,000 brokers regulated by FINRA, but 9 of them execute almost all of the large institutional customer orders. And then there are about 15 firms that set almost all of the prices. So if one of either group says, man, there's just too much going on, I'm not going to be making, I'm not going to make a market today, it can rupture the market. We really rest on the head of a pin. And I'm not negative. I just think you should be open-eyed, clear-eyed. If you're going to be a participant in the U.S. equity market, and you are traders and investors, then know how it works. And it doesn't mean you have to be scared of it. I'm not frightened of it at all, but I'm aware of the things that can go wrong. And that's important.
Tim Quast, Market Structure Edge. Final
Good to see
appearance,
you.
2022. We'll get you back next year.
See you in the new year, guys. Happy holidays, Merry Christmas, Happy New Year.
All
Take
right,
care, Tim.
Aaron, we got to catch up on that doc there, buddy. I told you we'd have more than enough.
I know. We've got 3 minutes left. We're gonna hit Meta and biotech real quick. Let's start with Meta trading down on some EU antitrust news. Let's go ahead and I'll pop that chart up for Meta. Give me guys each your 30-second thoughts on Meta.
Value is there. But again, it's core business is still getting tick-tocked. So for that reason, I just can't get in there because I think the worst worst times are still ahead for Meta. Not maybe the stock necessarily, but the company. So lots of bad news priced in here, though.
All right, Joel.
Prove to me that you can you close above 123.49. That's the high close of the move. You're ways away from that. Until you do that, path of least resistance lower, maybe giving back half of this move from $89.
There you go, Zuck. To get Joel buying your stock, all you gotta do get close above that 123 level. We're not quite there yet. 117 right now. Let's flip over to biotech. We had a couple big movers. I'll start with just the LabU ETF right here. The 3 times direction ETF trading up about 3% today. We also had some individual movers. MDGL, I believe, is that the ticker for the one we're get that right. MDGL has pulled that one up too, and Moderna as well.
I mean, one thing to consider, and I actually have been doing this and employing this now over the weekends, is the Friday night trade in XBI. And what I've been doing, and I'm just going to say this for the first time, is I've actually been going long XBI on the Friday nights. And I'm may continue to do that for just the possibility that we might get a merger Monday in the biotech sector. We might get something, and I hedge it out with the S&P. So, I'm just looking at, and obviously this MDGL news helped me here this morning because I think it's 0.65% or something of the XBI, and you got to stock up 200%. So that's giving me the outside news. So the MDGL, it's drug news for that stock. But I do think there's this opportunity here on Friday nights that I'm just looking at it and hedging it out. And you're not looking to make 3, 4, 5% of this thing. You're looking to just relatively outperform the S&P. So if XBI is up 1% here this morning, the S&P is up nothing, that's awesome. I mean, even if it's like 0.3% outperformance or 0.4% outperformance, you put some size on that trade and it's a pretty good trade. So I've been just doing that. I'm just starting to do it. And I might continue to do that into the new year because I do think some of these little biotechs are really beaten down. I do think you can see some individual stock, some of these smaller biotech stocks continue to get taken over. They are often announced over the weekend, which would make the move on the Monday. So I'm just, it's kind of like a little arbitrage. Well, no, it's nothing arbitrage, but it's trying to take advantage of the potential for merger Monday to happen in the small biotechs. So I like the XBI long on Friday nights now.
That's a very interesting trade.
I don't think you'll hear about that one. I made that up.
Yeah.
That's right out of my head.
That's the first time I've heard the long.
Somewhere else they ripped it off. They ripped it off of me because I just made that up right now, like in the last week.
Here we go.
Go to the MDGL. That's the big mover.
That's the catalyst that's driving XBI.
Yep.
Yeah,
It's up
MDGL up 200%. You can see the chart here. We have that whim. Why is it moving on Benzinga Pro? They've got some good news on this resmetirom trial with NASH and liver fibrosis. I probably messed up the pronunciation there, but you guys get the gist. They've got some good news. Stock up 200%. Trading now at around $200. Like Dennis said, bringing the whole XBI ETF up with it. Moderna an upgrade as well.
That helps XBI as well. It's a portion of it as well.
Moderna caught another upgrade from Jefferies, I believe. Trading really well, up 50% the last 6 months, but it is 9 a.m. Dennis, Joel, you guys got any final thoughts as we head into the open today?
Very important, taking it back to Tesla. Very important that, one, Musk follows through on what he said he was going to do, or Tesla's really going to get hurt. Two, the Tesla holds the gains and does lift when he officially announces it. If he officially announces it on Twitter, I think you'll see that lift again in the stock. It's very important that Tesla holds those gains, because this was, a lot of people were saying was weighing on Tesla. And if it can't get a relief pop from this, then it's telling me that investors are not so much concerned as much as we thought about the Twitter situation. They're more concerned about a potential recession in 2023 and that impacting Tesla's core businesses. So it's very important Tesla hold the gains here today.
Just for me, I mean, we're struggling here. We're trying to hold unchanged here. I'll go a little bit tighter than that low from Friday. I'm looking at that pre-market low at 72.75. That was also your last after hours print, so there was a little hesitation selling. So if we can hold that, then I think we got some room to the upside. Absolutely got to end this day in the 3,900 handle, or else I'm afraid the bears are still in control. If we take out that low for Friday, you can look on your charts. You can see what kind of support you had back in your stocks on November 10th and 11th, I believe, were the days, but they're not much in the S&P. I think we got to give AB a small hand here. He was traveling and being a co-host the first time on with us and throwing us some stuff to talk about. So great having you, AB. I know you got some other shows coming up later on, but great job. And Triple D, I'll check in with you.
Yeah, I thought
you
did a great job here, Aaron. We do appreciate you filling in for Mitch here on his day off. So, Aaron, thank you so much for coming in, helping us out. Great job keeping the show flowing well.
Of course. Thank you for the opportunity. You guys make it really easy. No struggle at all. But yeah, next time, hopefully if I get to join again, I'll be in the office, so I get a little bit of a nicer setup for you guys. But yeah, we've got live trading coming up. We'll have Benzinga live on after that. Hope everyone sticks around. We will be having the redirect there automatically. The only self-promotion I'll do, I'll drop my Twitter in the chat. If you guys want to give me a follow, please do. If not, all good as well. Dennis, enjoy the rest of your day. Hope you hit some good trades today.
Thank you. Okay, bye-bye.
Bye-bye. All right, guys. I don't know what happened to Joel. I think he might have just popped out. But, guys, thanks again for hanging out with us today. That'll be a wrap on pre-market prep. We're going straight into it with live trading. Again, you do not need to go anywhere. The redirect will bring you to live trading automatically. Guys, we'll be back tomorrow. Till then, peace and love, y'all.